Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from South Lake, Texas. Welcome to the show, Chad Zdenek.
Thanks, Victor. Good to be here.
Oh, great to have you here. You and I have known each other for a number of years, and it's been a while since you were last on the show. And the last few years have been maybe not very kind to the industry as a whole. A number of businesses have had to pause or pivot or make various structural changes. But maybe before we dive into the details, perhaps give a little bit of your backstory and how you got to this point in your journey.
Sure. Yeah, I would definitely echo that. It's been a challenging last couple of years for sure. So yeah, you could probably appreciate, I started out actually in construction and engineering in the mid 90s and worked on the space shuttle main engines actually. And as we speak, we've got a new rocket circling the moon, which is pretty cool to see. So yeah, I started out on that program and then started a business, which I ran for about 17 years in the lighting industry. Sold that business and went into real estate full time. So I did that about 10 years ago and started out as an operator in the multifamily and self-storage space, kind of utilizing my construction background as a sponsor of different deals. As things slowed down, I was looking to partner up with a larger company, and I had been investing passively with a company called passiveinvesting.com. So I actually had joined them just a year and a half ago. So I kind of have two roles now, my own portfolio, and then also working with them full time. So that's the two things I'm doing right now. And yeah, it's been a rough couple of years, but I think we've got the worst part of it behind us, and looking for brighter days ahead now.
Now, before we started the recording, you talked a little bit about a hiatus on the equity side for several years that is now just getting restarted. Do you want to talk a little bit about that, what that's been like and how you adapted?
Sure. Yeah, so that would be true both for my own portfolio and also for passiveinvesting.com. And they've got, just for reference sake, they've got about $1.5 billion of assets under management, larger company, a larger team. And yeah, they have not bought anything in 3 years until just 2 weeks ago. We got a new project under contract. So it's been a long spell on the equity side of things for sure. And this other deal we're doing, it's a $36 million purchase of 143 townhomes. So yeah, excited to do that. But it's been a dry spell for a long time. We've definitely have our own share of rough waters we've been through.
This is a business where, the paydays are great when they occur, but they don't occur every 2 weeks like they would if you work for the Postal Service. And so how do you keep the lights on? How do you keep the business operating over that time period? What's driving the business from a cash flow perspective on a day-to-day basis?
Yeah, that's a really good question. Obviously, with paused distributions, at least for us as a firm, we've also paused the asset management fees, which is typically what does keep the lights on for most companies. So we haven't had any asset management fees coming in, very little. A few of our properties still are, but it's nothing to write home about. So all in all, we have had to do that. Fortunately, we did get into the debt fund space early on. We started our debt fund almost 6 years ago now, and we saw a pretty big investor pivot towards debt as things started getting challenging in the equities markets, and that's helped us out a lot. Just last month, we raised $250 million for our debt fund. And it's basically a hard money lending fund for fix and flippers in the Southeast US. So I always like to tell people, especially if you're talking with like newer investors or maybe stock market type investors, like real estate is divided into, dozens, if not hundreds of asset classes within real estate, right? So if you're not really in real estate, you might think of it as an asset class, but that's really a super macro level. I think you really got to dive down a lot deeper into it to kind of find the nuances of it. I mean, this as good as anybody, doing development versus value add deals versus purchasing stabilized deals. And then you've got different asset classes. You've got different geographical areas. So there is really a lot of ways that you can diversify within real estate. And real estate very rarely will go into a cycle for all of real estate, right? There's usually these sub cycles within real estate. So, like for us with the debt fund, it's done really well. Single family home fix and flipping is done really well, and that's really helped us keep the lights on these last couple of years.
So if equity is the scarce item and a lot of folks are pivoting to debt, still at the end of the day, even if it's not you raising the equity, the other folks that are maybe doing these fix and flip projects, they need to at least bring a certain minimum amount of equity to the table, because none of these projects, I don't imagine, are getting 100% debt funded, because that doesn't make any sense. How have you seen the market cycle affect demand for your product on the debt side?
Yeah, that's a good question. I think our typical borrower is financing that delta by themselves. So we'll do, maybe 65, 70% LTVs. Like I said, these are smaller outfits, 200K size loans, and typically they'll fund the difference themselves. So I don't see our typical borrower bringing in outside equity for that delta. I think they're just covering it themselves. And then we're really scaling the debt fund based on volume. We're closing probably 1.5 to 2 loans per day. And then those are all on 6-month or 9-month terms. So pretty relatively short terms. And they're self-funding it themselves, that equity side of it.
And so then for you, whenever you look at a loan, there's two major components. There's the interest that presumably goes to the investors that are all part of the debt fund. And then there's the fees, whether it be origination fees, servicing fees, perhaps draw fees for construction. Those fees then go to you as the lender, correct?
Yeah, that's right.
Is that part of what drives the short-term cycle for these durations, these loan terms?
Yeah, I mean that's a big part of the strategy that we like to do. Basically, if you can turn over the investors' dollars twice in a year, you're doing really well because of exactly what you're kind of getting at. Those origination fees, the processing fees, they're not a whole lot to the individual borrower, but if you can get a couple of those fees for each time you're cycling that money over the course of the year, and then it can really add up and make a material difference to the fund itself. So for us, the 6-month product and 9-month product, that's all we do. We do offer like a 3-month extension, which obviously they have to pay additional points for. But generally, we're trying to get these people in and out. And kind of actually, we've been starting to move maybe a little bit more into your space on the land space, where we're doing land and manufactured home lending. So we are lending on the land as well as the manufactured home. And those tend to be even shorter loans, like maybe like 5-month time frames, just because the manufactured home space is so much quicker. But if we can do a 5-month loan term on that, that's really attractive to us as the lender to be able to cycle the money that quickly.
Yeah, it makes a lot of sense. Whenever you're lending money, you really need to qualify a few things. You need to qualify, the investment thesis for the project. You need to qualify the borrower to a certain extent, and then maybe the submarket. You obviously, if you're going to be, because when a lender lends money, they're really only asking one question, which is, if I lend you money, how am I getting it back?
Mm-hmm.
How am I getting it back if things go well? How am I getting it back if things don't go well? But it's really the same question. And there are, I'm sure, some jurisdictions that you simply don't want to play in because that sandbox is just not favorable to the lender. Can you talk a little bit about how you focus the business?
Sure. Yeah, that's a really important part of the risk mitigation part of what you do, especially when you're starting to, do this at scale like we are. So we're primarily in North and South Carolina. It's probably, 75% or so of our loans are there. That's where our team is based out of. And we have a really strong network of brokers, appraisers, contractors, subs, like we know those markets really well. And that does help us mitigate that risk quite a bit. Certainly, if we're expanding, generally, when we're expanding into other markets, we definitely have to look at the legal environment and the foreclosure environment. What does that look like? In some states, like we just won't do business in. It just doesn't make sense for us to do that at our size and for that level of risk. So we'll stay out of certain states because of that. Generally,
Not to mention any names, New York, right?
Yeah, not to mention any names. Yeah, you mentioned I'm in South Lake, Texas. I lived in LA for 50 years and finally just moved out 3 months ago. So I'm brand new to Texas. But yeah, so we won't do lending in California, New York, and a few others. But anyway, so we do pay very close attention to that. The other thing we do is once we've got a good borrower that we've got a good relationship with and have good experience with, we will follow them into other markets that we know and that we want to establish a footprint in. And that's just like one less variable that we need to deal with, right? The borrower variable, if you will. So as long as they've done work in that area and they've done work with us and it's somebody that we know and trust, then we'll follow them into these markets. We start developing relationships, and then that's kind of the seed that we plant to begin to grow. But by and large, there's just a lot of work, just even in the Carolinas, that keep us very busy. So that's still the majority of what we do.
I love it. Well, Chad, if folks want to connect, if they want to learn more, what's the best way?
Yeah, best way would be, I think, just our website, passiveinvesting.com. We got a lot of information on there, and you can find me there as well. It's Chad at passiveinvesting.com, or you can find me as LinkedIn as well at Chad Zdenek, Zdenek.
Awesome. Well, Chad, always great to catch up. And I think you've got some pretty cool videos, a documentary you did on an aircraft carrier, if I remember correctly, and a few other things.
Yeah.
Do you have those? Why don't you send me those links? We'll put those in the show notes as well for folks to check out.
You bet. Thanks, Victor.
Okay, well, Chad, great to connect. And for the listeners at home, definitely want to connect with Chad Zdenek at passiveinvesting.com. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.